Hey everyone, it's Ed Kime from Quantcha, and we are back for another day of the Quantcha Challenge. Now, yesterday we kicked things off with a covered call trade that we opened for Microsoft. This was primarily open just to get something on the books, but I also do have faith in the stock and want to get some of that volatility to work in our favor as we sold that call for 9 days out. I feel pretty good about the long-term prospects of the stock. Obviously, we're hurt a little bit today. The stock's actually down a bit, so we are kind of trailing right now. But again, these covered call trades, you don't necessarily watch them day to day. We'll come back and take a quick look at it probably a little bit later at the end of the session. What I wanted to do though in the meantime was I wanted to add a couple more positions in different stocks to start to build out our portfolio. So the first stock we're going to look at is Carnival Cruise Lines. I'm a big fan of Carnival Cruise Lines. I think that they have a great product. I think that their product has great long-term potential, and as something that I've used, it's something that I feel like pretty good about getting behind. Especially because as we look out over, let's say, the last 2 years, what we've seen is that the stock is pretty far down from where it's traditionally traded over the past 18 months or so. And I think that this one earnings call that disappointed. Now they beat on earnings, but they missed on revenue, and that really sent things into a tailspin at the time for that week. But as you can see, it's pretty strongly recovered, and that hit happened during the market sell-off. That was during a time when the whole market was taking a pretty bad hit. So I feel pretty good that we can go out and find a bullish trade. I don't necessarily want to trade earnings, so I'm going to return to their view. And I can see from our expiration chart here, I can see that earnings is pretty far out at this point, and that they do have a dividend coming up. And I'm not a big fan of trading bullish leading into a dividend, just because it does have some impact on the stock. But from my experience, for stocks that are going up, I've found that the ex-dividend impact against the stock of giving out that dividend is less impactful to the overall price of the stock because companies that are giving out that cash, they often don't drop as much as that if they are a company with a lot of positive support behind them. So we're just going to go out to that furthest possible date, in this case, February 22nd. And actually, I believe the liquidity for isn't great. They have poor liquidity for their options. So maybe what we'll do is we'll actually come back in to before that dividend and just go to the February monthlies to make sure we have slightly better liquidity for what we're trading. It may not make much of a difference, but I've selected that. It's about 5 weeks out, and we're going to say we're bullish on it. Now, we'll talk over time more about how this expiration chart works, but in a nutshell, each one of these yellow bars represents an expiration at a point in the future for the underlying stock. We've got lines in here to tell you when the next dividend's happening as well as when the next earnings is happening. And then you can add in some of these other things. For example, the implied volatility. We can add in the historical volatility to see how performance has been. Now, everything here is forward-looking except for historical volatility. So when we look at, like, for example, these two price points, we've got the implied volatility down here, which is forward about 30 days, in this case 29 days using that expiration, and the 30-day historical volatility is up here. As we can see, it's been pretty volatile from that drop, but this gives us a good comparison to say, like, hey, should we expect that level of volatility? And historically it was pretty high, but it's not really a great measure of how we should feel about it. At the same time, we can also take a look at our IV rating, or of course rank and percentile, which will all generally be about in the same ballpark. And if I get rid of these guys, we can see that IV rating, which is one of our ratings, is proprietary, an estimate of the percentage likelihood of the volatility dropping between now and the target. Between now and the rating is about 80% for the term we're looking at. So that's a pretty good indication that volatility is high. So we'll probably end up wanting to sell a put spread, which we'll get to in a second. But let's go ahead and we'll just select this expiration. We'll say that we're bullish, which will give us a default range here, which represents a 0 to +1 implied volatility movement. So if we select this, we can actually tweak it and hand edit it and drag these around. But the range presets from the previous page is relative to the expected movement of the underlying between now and this expiration date, all based on the implied volatility from the options pricing. Now in this case, we went with the moderately bullish, that 0 to +1 volatility movement, and we'll just leave this as is. We'll come back and spend more time on this another time. But we can see from these trades here that these are the best available trades for that movement. So if we're going to go out and we're going to trade this, this is basically saying, hey, from that zero movement, like we're using a view right now to model all these trades against that are saying what happens if the stock basically doesn't drop between now and then. Like what can we expect? And we can see a lot of good trades here. Now, what I like to do is when I'm looking at these sort of bullish trades, I'll use the return filters to sort of gauge where I want the P&L to fall, which side of the current price. So in this case, the minimum return of negative 100 simply says like, hey, just give me all the trades. Anything that fits the other parameters, just use what we have and go ahead with it. But in this case, because the stock is trading at 52.24, what I'd really kind of like to see is to say, well, I don't want to lose money if the stock moves up. So I can say that for this view, which kind of starts in here, show me what happens if I move this to zero. Don't show me any losers that would happen if the stock doesn't go down. So because I'm bullish here, I'm just simply saying from here through the next 5 weeks or before then, I want to be able to profit if the stock doesn't go down. I'm not super bullish again on it, but I feel confident enough in the fundamentals and the underlying and everything else going on that I feel good about it. And so we have this particular trade here. Now the other thing too is I'm going to budget a little bit higher for this. I'm going to give myself a $500 budget for this trade, which represents about 2% of our portfolio. And this will go out there and it'll just kind of calculate. In this case, it's simple. It's just two more. I'm taking on a risk of $340. And then if we click through, we can see the details of this trade. And part of the challenge here is that we are using the pricing in this case. We're using pricing that is the market pricing. So we're saying we would be buying the offer and we would be selling at the bid. Now, if we wanted to zero in a little bit more and say, well, what if we shaved it down to midpoint? We could actually get a reanalysis here, which will give us, for example, it'll trade this as though we were buying at 90, we were selling at $1.85. I don't like to do that. I'd rather work with the market pricing to say, like, give me the worst case expectations for getting in right now, and then I'll try to shave it down in the trade ticket itself. But based on the pricing, as we can see it right now, what we're looking at is we can basically move three of these around for that $500. The pricing looks like it moved a little bit. And now at the same time, while this is our view, saying we don't want to lose money if it goes up or if it doesn't go down, this is the view of the broader three volatility movement. So this is the part of the chart that's sort of like that us being honest with ourselves. Like, this is what we expect to see, but this is more likely what's going to happen in terms of a distribution. And we can see here that we are looking at a trade that's got over 50% probability for profit, which is nice. There's a lot of volatility going on in the market right now. So what we're probably going to do is we're going to have something else to offset this a little bit later on, at least offset its beta. This way, if the market has a significant movement, it'll cut off the loss we take here by a gain somewhere else. So kind of long-winded there. Now, we don't really have any position open in Carnival right now, so I'm going to go right to the trade ticket. This is a trade that we do want to open. We're looking at 3. It's got our setup. I'm going to try to open it up for a credit at the midpoint. I think that should hopefully fill pretty quickly. And maybe for the purpose of this, we'll just move up a little bit more. We'll try to ask for $1, and then we'll manage that order if we can. So we're taking on a total cost here. So the order proceeds, we're going to collect $300 in credit for this trade, but we do have a $750 margin requirement because we have 300 shares under control for a $2.50 spread per share. So that represents the $250. So the total cost here, even though we're collecting $300, the reason we get a total cost of $450 is because we're going to have to put cash of $450 in margin to cover not only the 300 we received in credit in order to reach this 750. But the nice thing is we've got no commissions and the fees were negligible for this trade. That 350 looks pretty good. I'm going to submit the order and kind of let it hang for a bit. We will probably have to come down to 95, maybe even go a little bit lower to close this, but we'll deal with that later on. In the meantime, the other trade that I find interesting is I want to get on the other side of something, and I want to get on the other side of Exxon. I think that over the long run, this company is going to have some trouble. We're looking at the stock has been, kind of moving around with the market lately. It's obviously heavily leveraged to oil, but we've seen sort of a slow decline. If we go further back out, we can see that, it's up, but then it's taken some big hits every time there's a problem with oil or any time that the market overall has problems. It does move a lot. So What we're going to do is we're going to look for a trade. Now, I really don't want to trade them through earnings. So this is sort of tough because their earnings is so soon. In fact, they announce, I believe they announce on the morning of the 1st, which is a Friday, which is this expiration. So we really don't want to trade them. In fact, I'd be more inclined to probably trade them for foreign earnings, like using a strata leading in there, and we may still do that. But for the time being, we're going to kind of stay away from that. We're going to look at a trade. Um, we may consider going out 2 weeks, although that's really short. So this is one of the decisions that we have to come to here, is to say, if we trade the earnings one, we would probably want to close that trade out before we get to earnings. And the question is, will they drop leading into earnings? And I think they probably will. I think they're going to take a bit of a hit going in because there's a lot of concern over the stock right now, and the analysts have been revising downward. But at the same time, if we come back here, we give ourselves a little bit of a buffer. I'd say let's see what we have here trade-wise to go out to that. If we look at the IV rating, I mean, we are expecting, the IV rating is much higher, so we're expecting the volatility to drop. I mean, it's definitely looking, even in the short term, it's still very elevated relative to the past year. So let's go ahead and we'll just take this one and we'll take a bearish look at it. And this, again, like we did bullish before, this is a 0 to a -1 volatility downward movement. And one thing to note here is because there's so many options, we pare down to 50 options by default because you might be using this on a phone or anything else. By the way, if you are using it on a phone, you can just, you get an experience that just scales down. So if you're on your phone, you can access it, everything in Quantcha is available and pared down to give you the best experience we can. But in this case, 50, we have a high-powered machine here, so I'm going to go with 100 options just to bring them all into the mix. And so now it's churning through, the 100 options that are selected that are the best options for the fit for the view we have now to try to find. In this case, there were 96 total options, so it's using all of them. And there's an interesting trade here. Again, we have our minimum return set at 0. So we're saying we want to profit here as long as the stock doesn't go up from the point it's at now. So if we're looking at this trade, I mean, the potential at 92% is pretty nice for this. I'm going to dig in. We have the same $500 budget here, so we'll dig in and take a look at what we've got for the actual opportunity. I mean, this is, again, it's just a spread going in the opposite direction. If we come down further, we can see it's going to give us a negative delta. But what we'll actually want to see is the impact of that delta against our book with the Microsoft and the Carnival holdings once we get those in place. But again, this is some potential for some good credit. Odds are we're not going to get full credit on a trade like this or a trade like the Carnival one, but between the two of them, hopefully as they shake around, we should be able to do pretty well. But the average return is a little bit low here, but I think the low has to do more with the liquidity right now. So if we were to change this to use midpoint pricing, which might be too optimistic, it should give us a much better return. But again, we want to be honest with ourselves, stay with market. I'm going to come over to the trade ticket, and again, we don't have anything in Exxon, so I'm just going to throw this to the book and see if we can land it at a good deal. Pretty wide spread right now. I'm going to try to ask for $1.10. I mean, I know we're not going to get that, but that's about the net pricing right now. So we'll ask for the credit there. Again, it's a call spread, so we'll put that in and we will submit it. And now we have 2 orders that are sitting out there. Let's go take a look at where we are with Carnival. So the Carnival trade is actually starting to move. It was at 95 cents because the stock's moving up. I'm just going to go right to the midpoint, see if we can close this out right now. Let that hang out for a second. If it's not closed, I think we'll probably get pretty close to a fill as it jostles around the pricing a little bit there. And then for Exxon, let's see what we're looking at. The 103, that's probably a bit more. I'm also gonna put this at midpoint just so we can hopefully get a fill soon. I know that these stocks they're gonna jostle a bit. I feel like if we put them at midpoint, that as they move up and down, the option pricing will sort of at some point just find a way to get us where we want to be. So we'll let those sit. Now I wanted to come back and take a look at our holding here, which is the Microsoft covered call. And again, it's 1 day in, so we're not going to panic about the fact that we've lost that much, that we're down $60 on the trade. This is expected to be held, even if it's just held for 9 days. It's a longer period of time. We do want to hold the stock, so I would like to hold the stock at least. I mean, it does give a dividend, and the volatility is pretty good, and the underlying is very strong from a fundamental point of view. It does have some exposure to the government shutdown that could be impactful. But in the meantime, one of the things we want to take a look at is we're going to see what happens when we go to manage our book. So the book manager is a really great feature to figure out, like, hey, what do we want to do with the positions we have now? So this is the P&L that shows for that covered call that we opened, which is the stock at 100 shares of stock and the 105 call short on the 18th. We can see this is the P&L for the 18th. Now, if we wanted to pull it in a week and say, well, what would happen? What do we expect on the Friday, which is, in this case, tomorrow? We'd say, well, depending on the movement of the stock, this is what we'd expect to see. We can jump around, see different options there, but we're just going to jump ahead to the expiration. Now, a lot of times people look at this and they say, well, maybe the stock, we don't feel so good about it anymore. And we're thinking, yeah, there's a good possibility it's going to stay below 103 between now and then. And if we feel really convinced that it's going to be below 103 at expiration, it doesn't help us to sit here and hold on to the options as they are at this 103 point. Instead, what we'd probably want to do is we'd want to go and roll down to sell the 103, or maybe roll out or do a variety of other things. But in this case, we've got this 105 call on the 18th. I'm going to click the roll options, and this will give us the ability to select which expiration. In this case, we'll stay with the 18th. And now we can see the impact to our books that would be if we roll to any of these other options that are available. So if we wanted to go to the 103, we can scroll down, locate the 103, and get a preview of what the difference would be. Now this tells us we would collect $87 in credit. We would actually lose quite a bit in our delta, and then gamma, and so on and so forth. But if we chose to roll to that, now what we have is a pending book. This is our pending book, which will be shown up here in yellow. So the yellow is what happens if we make the roll, and the blue is what happens if we don't. So this is our current holdings, and the yellow is saying, hey, if you want to make the change, here's where you go. Now there's a couple things to note here. The first one is the simulated returns here, which are using the Monte Carlo modeling. The probability of gain in the simulated return for the current book is about 57%, and the mean return is to lose about 10 bucks. On the other hand, if we made the roll, we would go up to almost 2/3 probability of a gain, and our mean return would lower significantly. And that's because we're hedging our downside a lot more. And we can see the distribution here. So this is saying, like, if you were to take all the distribution and you were to line them up in order of the biggest losses to the biggest gains, and then do in 5%, every 5%, here's what that 5% bucket looks like. And this gives you an idea of how to visualize, just to show that in the current position, we're looking at a slightly bigger loss here. These guys look like they're slightly bigger up here than they are down here. We can see at the midpoint moves a little bit further to the left for the pending book, but at the same time, the upside potential is clearly a little bit bigger for the return if we stay with the book we have now. Now down here in the pending book view, there's a couple things going on. This shows us what the current state of the pending book is right now, because all we're working on is saying what would happen if we wanted to come in and make these changes. Now we've got the 100 shares. We went and we rolled this call down, and we could see we've got to track changes here, and this tells us, hey, you sold. We're gonna buy back this call, and we're gonna sell this call to replace it. So that's the two things. The pricing here. We could jump to a trade ticket if we wanted to, but for now we're gonna stay with the pending book, and we can see some of the details. Like our current book has this value, these Greeks. If we were to make the changes we're looking at here as we collect them, the pending book would show us what the pending book would look like. We'd have slightly less in market value, we'd have a lower delta, our gamma would be a little bit lower, we'd have a better theta. The change, then we can actually break out here specifically to say exactly what those changes would be. Now, the other thing that's important here is it shows our overall portfolio. So right now the portfolio is just the Microsoft positions. So we have this market value, we've got our delta, gamma, and so on. And the beta is the one that we care about here. This is the impact to the beta. So our overall book. And the beta means simply that for the S&P or the SPY ETF, for every dollar it moves up, what would be the overall impact to our portfolio? And in this case, right now, you can see we're a little bit more bullish than we would be if we made this change. Now, we're not going to make a change yet. We're not going to panic just yet. We're going to see what happens with the Microsoft stock and maybe trade that over the longer run. But as we start adding more positions in elsewhere, we're going to care what our beta is, because right now, this number here, this simply means that we're going to do better if the market moves up, which makes sense because we have one bullish trade, and that's for a stock that has a positive beta. So we're cheering for the S&P to move up right now. But realistically, with the volatility we've had, we should probably not really cheer for it one way or the other, we should probably want to keep this closer to zero so we get less impact every time it moves up or down. Now, I'm going to step out, take a look back at our orders. Now we can see that the Carnival Cruise Line order filled. We did get the 90 cents for it. And if we come to our portfolio, we can now see that we're holding that position. Now, we are down that $45. That is primarily because we filled, what we did was, we can see we were short here. We took what is the current bid at 180, and we have the midpoint is what we were able to sell at for that. So we're down about $5. But more importantly, we bought this at 90 cents a share, and the spread is now 85.95, which means that we're pricing this for that 85, saying if we had to sell these off immediately and liquidate them, we would assume we could only be confident in getting this 85 cents. So, again, I use the analogy of the snap in football. Like when you first enter the trade or you first start to play, you're going to lose a little bit of ground. But over the long run, hopefully we made the right call here, because this is very much a directional trade. Now we can take a look at our Greeks here and see that, because we've got these two bullish trades, both of them have lower beta weighting that add up to this $50. So we're now looking at $50 in gain for every dollar the S&P goes up, which is great if we expect it to go up. But right now, I don't feel confident that we expect it to go up, and as a result, we're a little bit worried about, if it keeps going down, we don't want to have that $50 hit. And even worse than that is, if it goes down, then what we would expect to see is that we would take more. Because our gamma is negative, in the event that this goes down, so we've got this -6 gamma for our beta, which means that if the S&P goes down $1, that we would expect delta to go up $6, because it's the opposite, because it's a negative here. That means that this number would get bigger, which means as it continued to go down, our portfolio value will go down faster and faster. And so that's one of the risks we have. And once we close out the Exxon order, we should hopefully be able to get in. We're going to chase this down. We're going to get this closed now, just to get in on the position, to sort of balance our book a little bit. We don't really want to sit around and have be too leveraged one way or the other. So we'll try to move this down by the pennies to see if we can get somebody to come and fill for us. Again, the Exxon liquidity not great. We're now inside the midpoint. Not super exciting for live streaming, but this is how the sausage is made. I mean, this is something we all sit around and do, trying to edge in to find the pricing. So we did get filled at 99 cents. That's fine. We'll take it. We'll come back, take a look at our portfolio, and now we can see from our Greeks that we still have a beta weighted positive, because when we open this position for Exxon, the overall impact to our delta didn't quite offset the Microsoft. It definitely offset the Carnival pretty well, but it didn't quite do that. So at this point, there's a few options we could have. I'm not too worried going into tomorrow with a gamma this low. It is possible that the S&P drops 5 points tomorrow, in which case we take a pretty big hit. But for the time being, we're going to probably just cut it off here. We're doing all right. I mean, again, we're going to take some losses. The goal for this month is to just get positive, is to just try to get us to eke out a 1% gain, which means that we're doing pretty well if we can pull it off, because between liquidity and opening all the positions and some of these shorter term trades, it's easier said than done. But I do feel pretty good about the positions we're in, and we'll just hope that we're not looking at a big market drop, because if the market tanks on us, then because of our position here, we are looking at a substantial amount of risk. So we're gonna hold it off here for now and come back in tomorrow, see if we can add some stuff in here to hedge off our positions a little bit more. We're gonna try to get this beta closer to zero for the beta weighted delta closer to zero. This way we can feel a little more confident about what happens when things shuffle around. Quick review of the positions though. I always like to do this at the end of the day. Make sure you got nothing expiring too soon, nothing that's short, that's deep in the money. Take a look at our earnings releases to make sure that they're not too close. ex-divs are fine. When these trades do happen, when we are very close to a dividend or an earnings release within 7 days, this will light up red to just give us a heads up so we know what we're in for. But like I said, we'll head it off here for now, and hope that we see some positive movement tomorrow in our favor. If you have any questions, please hit us up at hello@quantcha.com or leave a comment below. And as always, good luck and good hunting.